The Federal Reserve has officially flipped. We have some major developments to discuss from today's FOMC meeting, which is actually bullish for the future of stocks and signaling an end to the mayhem we have been seeing in the market today. Not only has the Fed signaled at a potential policy change within the next 6 months, but they've also completely revamped the way that they're going to be judging interest rate hikes in 2023. And that will give a lot of confidence to most investors. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's summarize the key takeaways from Powell's press conference, where he mentioned the Fed could indeed slow the pace of rate hikes within the next 6 months, even if inflation data does not improve. And he also mentioned that overnight, they will not stop pausing interest rates anytime soon. Now, if you're a short-term trader, this is probably a good thing because it means markets potentially have more volatility in the next 6 months and potentially even more downside to hit a fresh new 52-week low. But if your investment time horizon is anywhere more than 6 months, then this is fantastic news, because what the Fed has just told us is that they're officially going to start looking at leading data about the economy when judging their interest rate path. In a new statement, the Fed said that they're going to account in the economic and financial developments in the overall economy, which obviously lags their monetary policy effects into consideration over the next 12 months as they increase rate hikes. And we already expect them to lower the pace of rate hikes from the current 75 basis points to 50 and 25 basis points going into the spring of 2023. And as of right now, the expectations are that the terminal Fed funds rate is going to be 4.6% by the end of 2023, which is obviously much higher than where the market is pricing it at today, and hence we're seeing yields rising. Now, I've already said this in the past, but rising interest rates typically are not bad for stocks. They're only bad when yields are rising surprisingly and there's little clarity on the path of the Fed funds interest rate over the next 12 months. And the report that just has come out is giving us a lot more clarity, which could play into the hands of a better stock market performance. Because guess what rising interest rates actually mean? They mean that the economy is probably doing too good, which means that corporate profits were too high. And so basically we're going to see a mean reversion and see the market come back to the levels that it saw in 2019 when it comes to earnings and profits, which will not only restore inflation, but also bring down valuations and allow people to invest at cheaper prices. And guess what? After every single rate hike cycle over the past 40 to 50 years, the market has always provided an average of a 41% return for the Dow Jones and around a 30% return for the S&P 500, which is obviously an extremely good return, especially in a high inflation environment. And so really the key thing to keep in mind is that interest rates going up does not directly mean stocks are going to go down. It's only when interest rates are going up surprisingly and shockingly to most investors, which is exactly what we've been experiencing for the past 6 months. But the reality is that phase is not going to last forever. And chances are, even if the terminal Fed funds rate is going to continue to go to 6 or 7% by summer of 2023, the market might already bottom 6 to 8 months before that. And when you start realizing that 40% of the CPI is based on housing, with around 20% of that being transportation, you start to understand exactly why the leading indicators are showing inflation will start coming down sooner rather than later, which means that the Fed can potentially give us a more clearer path for cutting interest rates, which is exactly what the stock market reads right now. And as you can see from the data, there's no denying that home sales are literally hitting all-time lows for the past 20 years. There's very little demand for new housing out there, and constructions have come to a complete standstill in most cities. And that's because obviously the mortgage rates have hit almost 8%, and people are rushing out of stocks as they lose and see their wealth completely get evaporated. And that is simultaneously resulting in car prices collapsing over the past 6 months, which again should bode very well for bringing down the overall cost of transportation, which as usual is a very big component of CPI. And even though on a year-to-year basis, rents have increased, on a month-to-month basis, they're actually starting to come down. Now, this is an argument a lot of people did bring when it comes to addressing inflation, which is the fact that as mortgage demand falls, the demand for rent is going to go up, and as a result, that's going to increase rent prices. But that is not what the data is showing us. If you want to look at the lagging data, then yes, rents are higher. But if you want to look at the leading data, rents are actually falling. Now, obviously, this could change, but all we can do is look at the current trend to identify where inflation could head in the next 12 months. We're not trying to make bets on what's going to happen based on what we want to happen. We're going to look at the data. And even when the month-over-month increase was increased significantly in July 21 and May of 22, the trend is still down. And this right here is probably one of the best leading indicators for that CPI housing component. But obviously, I'm sure you guys are asking, what is separating today from what happened in 2008 if the housing market has such an impending collapse coming in the next year or so? Well, in 2008, we were lending out money and mortgages to folks that were 18 years old, fresh out of college, and with a zero credit history. But right now, we're not seeing that. Actually, the average credit for people that are being lent on mortgages is around 790. And right now, we're actually seeing inflation, which means that demand for properties is high, unlike in 2008 when demand for properties was low. And guess what the craziest part is? Shelter inflation is always lagging CPI by around a 4 to 6 month time frame. As you can see, CPI overall skyrocketed in early 21, but shelter inflation only started rising in the late half of 21. And so now that CPI is going to start coming down, shelter inflation is going to take another 6 months to really start coming down. So if we're going to look at the housing market and shelter data to understand how CPI is going to come out, you're going to be way behind the game. So it's much better off looking at leading data than looking at the current data about where the market actually is. And even funnier, the fact that shelter inflation lags the housing price growth itself by another 6 months. The Case-Shiller in dark blue has always risen before the CPI shelter index, which means that right now, even as housing prices start to fall, which we're already starting to see, the CPI shelter is not going to start falling until another 6 months. And so as a smart investor, if you really want to time the macroeconomic situation and this potential Fed pivot with inflation coming down, then this is what you want to look at. But it's obviously important to also address the other side of the coin and explain what could be causing inflation to be more sticky. And I'm going to say it right out. This right here is the main reason for that. The US economy is simply too strong. People are still going out and spending money. And that's the reason why we saw GDP grow in the last quarter, which actually technically puts us out of this recession. But as we all know, on a tech basis, we're in definitely a recession. Now, it's a matter of question how far of a recession we have to go into for this inflation to come down. But like I just showed you, the leading data is indeed showing us CPI could start falling soon. And with the Fed already having outlined a better path for interest rate hikes, that could lead to more certainty for investors. But if job openings continue to increase, which is something we saw in the latest JOLTS report, and the average wage also starts going up, that could be a bad sign for inflation because it means it's going to be more sticky, resulting in a tighter Fed. Because right now, people have a lot of savings, but they are also starting to use credit cards a lot more, resulting in still some leverage that needs to be taken out of the market. So if inflation does not come down to the Fed's level by that time, and this is how the data looks like, then yes, interest rates are probably going to need to go a lot higher. And as you can see, with the macroeconomic situation deteriorating a little bit over the past 2 months, especially with what's going on in China, the average 5-year break-even rate has started ticking up from 2.26% all the way to almost 2.8% over the past 2 months, which again is a leading indicator of where inflation could be in the next 5 years. And this is the number one thing the Fed is probably want to looking at over the next 6 months. Because as you can see, this shows the unemployment rate is not going to start ticking up anytime soon. Total separations decreased to 5.7 million in September, and the number of people that quit their job stayed flat. Now, this obviously would be a good thing in a normal economy, but when the Fed is fighting against growth, they don't really want to see this. Even layoffs and discharges, which are typically done at the discretion of the employer, edged down in September to 1.3 million. So overall, the JOLTS report does show us the economy is actually stronger than the Fed had initially expected. So it's certainly possible that this turns out to push inflation even higher and remain stickier in the next 6 months. But as a long-term investor, I'm always reminded of this chart. No matter the macroeconomic situation in the short term, the market always outperforms in the long term. Now, obviously, there's a caveat whether or not you're picking individual stocks or investing in the index. And I personally have a lot of my portfolio in index funds and a lot of my portfolio in hand-picked stocks. But I always resort to answering the question the same way, which is that the best businesses are always built in a recession. And right now, the Fed has put us into a recession with the layoffs, revenue, and earnings decreases we're seeing over the past couple of earnings reports. And so if you're a good stock picker, if you're buying the right businesses, then they will most likely thrive out of this current downturn. And so in reality, there's probably never been a better time to be a long-term investor than right now. We're seeing the Fed artificially put us into a recession, reduce stock valuations, and result in a lot of the credit and leverage being phased out. And even from a technical standpoint, as interest rates tend to increase, as shown in yellow, the market does tend to perform well in the long term. It's just that in the short term, as the Fed is changing their policy, there's a lot of uncertainty, and that results in the stock prices collapsing, which is exactly what we experienced over the past 6 months. But in the long term, the market does thrive, especially under higher interest rates, which is exactly why right now is yet again one of those great opportune times to invest. But obviously, if you disagree, let me know your thoughts down in the comment section below, because it's obviously good to understand what the other side of the coin also thinks.